Hello, everyone. Today on the Final Bar, we'll do our normal Friday routine. We will wrap the week. We'll focus on the last 5 trading sessions, how the markets have evolved from last Friday to this Friday. Further distribution seen through the course of the day today, following through the distribution we saw into the close yesterday. Not a climactically negative move, with the S&P only down about 0.8%, but the NASDAQ bouncing off of being down over 2% earlier in the day. So you're seeing value over growth. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. Happy Friday. This is Dave Keller, Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market environment using the power of stock charts, using data visualization techniques, the best practices of technical analysis and behavioral finance to best understand what's happening in the world around us. There's no doubt this week, among many weeks, highly uncertain or high uncertainty, high elevated volatility. No one really knows what tomorrow is going to bring at any point in the markets, but it feels that way more than ever now as you have so many potential competing narratives, so many things you have to focus on that are outside of the traditional financial analysis spectrum. At the end of the day, though, I would argue charts are one of the best ways to navigate through all that noise. A lot of times, different news flow, different headlines, different comments that you'll hear are noise, and it can distract you from the pure message of where assets are going. That is the discipline of trend following. That's the discipline of technical analysis, is to focus on what's happening, what's working, what isn't, and try to make sure that you're aligned with the trends that are performing in your favor. We'll try to go through as many charts as we can in 30 minutes and help you draw a close to this week and make sense of it from a technical perspective, set you up for success next week. We have great guests on the show. I had a lot of fun yesterday with John Gagliardi joining us from Fidelity for the first time. Next week, we have Matt Tuttle from Tuttle Capital Management. That's coming up on Tuesday the 8th. Matt is the founder of Tuttle Capital and manager of a SPAC ETF, a short innovation ETF, some really interesting funds. It'll be interesting to get his take on things. On Wednesday of next week, we have Jonathan Krinsky from BTIG joining us from Minnesota. Also, on Tuesday of next week, we have our latest episode of The Pitch. The Pitch is a monthly exercise where we bring in 3 guest experts and have them each pitch you 5 ideas in celebration of Women's History Month. It is all women participating in the event this week, and it is very much going to be worth your time and attention. Aaron Swendlin from Decision Point is going to moderate a really fun conversation with Mary Ellen McGonigal, Mish Schneider, and Danielle Shea. Very much worth your time. Go to StockCharts.com/thepitch for more information on that latest event. Let us wrap the week, which is a focus on the evolution of these markets over the last 5 trading days. We're going to start, however, with a poll. Recently, we asked you on social media and on our Stock Charts live stream page, which of the FANG stocks performs best over the next 3 months. And I gave you basically the 5 stocks: Meta Platforms, Apple, Amazon, Netflix, and Alphabet or Google. Almost half of you answered Apple. Second to that was Google or Alphabet with about 30%. The rest of those were all single digits up to 10%. Let's look quickly at each one of those. Let's see. So Apple was the top respondent. And what's interesting about the chart of Apple, what's compelling about it, is even though the market has been struggling, even though technology has been hit pretty hard, look at the relative strength since November. Now we'll look at the XLK here very quickly. You can see how the relative strength since November into December has rolled over. It's making a new relative low for the last 6 months today. Compare that to the chart of Apple, which is actually seeing its relative strength increase, meaning it's actually doing better than the market has been since mid-November. So if I had to pick one, I probably would go with Apple as well. Now you can compare that to the other charts on the list. Alphabet below its 200-day moving average, relative strength sort of in the middle. Amazon is getting hurt along with the other consumer names. You can see that's broken down through moving average support, testing the 50-day from below, but now below 2 moving averages. What else have we not done? Facebook is sort of gapping lower. If I had to pick the worst of the bunch, that would probably be it, with a big gap lower and then continuing to the downside. And Netflix is a similar pattern to what you saw with Facebook there. So the two communication names sort of gapping down pretty good. Alphabet hanging in there a bit, and Apple certainly the top performer of the five if you look over the last couple of months. So I would have to agree. Final Bar Nation, thumbs up, I would say. That's a fairly decent call based on the best practices of the technical toolkit. Let's continue on today's show as we wrap the week. We will start with looking at the major averages over the last 5 trading days. Let me bring up that chart right here. It's a little crazy because we've had such a severe move in crude oil prices. Let me bring in the previous day. Here we go, 5 days there. So we're going to start the clock last Friday, the 25th. We're going to go through the 5 trading days this week, and you can see the different asset classes notated here. If you follow my voice and the mouse, you'll be able to see what's what. The S&P finishing the week down 1.3%. That's the black line there. These next 3 underperform the S&P. In purple, you have small caps down 1.9%. In pink, you have the Qs, the NASDAQ 100 down 2.5% about, and then the worst performer emerging markets down 5.7%. Everything else on the list has outperformed the S&P, and all of them are actually net positive for this week. In green, we have the U.S. dollar, and we're using the UUP there, which is a bullish dollar ETF. That's up 2%. In red, we have bond prices using the TLT ETF. That's up 2.6%. Gold prices up 4%. We're not used to gold being in sort of the leading top of the list here of the leaderboard for the week, but you're starting to see gold pop up that way. And crude oil, by far the top performer. The USO is up over 20% just in the last 5 trading days. So certainly there's been an upside acceleration. Of course, a lot of that is driven by events in Ukraine, with Russia, in Europe, and broadly speaking, all the ramifications of that. And again, with military actions, a lot of times it's all about the expectations and how things play out. There's a lot of headline risk right now, and so I would encourage you to take a step back and look at the trends. We've seen stronger energy prices even up until the last couple of weeks, but they're accelerating to the upside for sure, just given the uncertainty and given the events that we've seen there. If we add Bitcoin to the mix, this is what that same chart looks like. This blue line is Bitcoin. It's a little more volatile than everything else, so I tend to remove it from the list just to get some of the noise out of the way. But if you look at Bitcoin, it's actually had a pretty good start to the week, but now coming off aggressively. Finished the week up 0.5% from where we were last Friday. But overall, certainly it's showing a lot of distribution. Bitcoin and Ether both accelerating to the downside today. Let's just check in really quickly with what happened today. I mentioned the S&P down 0.8%, the NASDAQ doubling that negative percent return today, down 1.7%. The VIX is up back above 32. This is actually nearing the 30 level over the last couple days, now rotating back to the upside, showing increased volatility. Mid caps and small caps both underperforming the S&P yet again today. Interest rates coming off today as bond prices went higher. This is very much a risk-off feel to the tape, with a lot of the offensive sectors at the bottom of the list, some of the defensive sectors like utilities and real estate at the top of the list. So the TLT was up 1.7%. The dollar index up 0.76%. And the dollar tends to be obviously a safe haven currency, for lack of a better term. So when there's uncertainty, when there's a lot of instability, you tend to see assets go into U.S. dollar-denominated assets, generally speaking. So you're seeing dollar-denominated bonds and the currency both going up today, and I would attribute both of those to sort of a safe haven move, a defensive move. Commodities overall accelerating, with gold and silver prices both up 1.5% today. That's using the GLD and SLV, and the other commodities, even the soft commodities, up pretty well. Flip the commodity charts over the last couple of days, and you have cryptocurrencies. All 10 of the major currencies and major coins we track here down over the last 24 hours. You have Bitcoin and Ether both down over 7% across the board, showing some decent weakness. Let's look quickly at the chart of Bitcoin, and then we'll get to the Mindful Investor Live chart list. This is what Bitcoin looks like. And so what's happened is you had a clear accumulation phase, I would argue, sort of summer to fall of last year, going into the peak in November. It's interesting that Cryptocurrencies actually topped out mostly in November of last year, and that's how I've tended to describe the end of the bull market phase for stocks. Even though you had some of the indexes moving higher December into January, that's when you had a peak in momentum, a peak in breadth. A lot of those things happened in November. So I would argue that's more where the top is. And it's interesting that that's where the prices of Bitcoin and Ethereum and others topped out as well, rotating to more of a risk-off feel or a distribution phase. But if you look at what's happened so far year to date, sort of choppy sideways, right? We came off in the first week, but from there we're sort of rotating around a median right around 40,000. So currently we're trading just below 40,000. We've spent the last 8 weeks just rotating around there. That's sort of the equilibrium price. That's the center of the price action so far year to date. That lines up pretty well with the September low of last year, peaks that we saw earlier in the summer after that sell-off in the spring of last year. So overall, what the chart is telling you is that Bitcoin is settling into kind of the right price, right? That's sort of what Bitcoin is worth right now, and you have attempts of buyers to push the price higher. Those are being repelled. You're seeing sell-off as sellers take control, and you're seeing those repelled by buying interest coming in. So overall, I would argue Bitcoin is kind of right where it needs to be. This chart will tell you when that changes. And if you think of this as a big rectangle, at some point we break above 45,000, we break below 35,000. One of those things happens. I would argue that probably tells you the next big move that you're going to see in Bitcoin. We'll finish off here looking at the Mindful Investor live chart list. To get to this chart list, to go to the Articles tab, go to my page, which is called the Mindful Investor, and you'll get to this list of charts at the top of that page. I keep this updated pretty regularly. We start with the market trend model, which is a simplistic way, a trend following mechanism that I started following years ago. It's just a way to look at 3 different time periods and quantify what the trends have been. And I was doing that subjectively. I was just looking at a bunch of charts every week, and I found I could create a systematic model which very quickly mirrored my subjective assessment. And it was it was a great time saver to be able to look through a bunch of charts and just look at their different time framed trends. So we have the long-term trend remaining positive. You can see this has been sloping downwards more and more over time. It needs to get below the 0 line to turn long-term negative for me. So it's still telling me the long-term trend is positive. The medium-term and short-term models both turned negative in January and have remained negative for the last 7 weeks or so. So overall, this is telling me the long-term trend is still okay. The medium-term and short-term trends are both negative. And so that tells me in terms of risk on versus risk off, I want to be thinking more risk off. I want to be thinking of opportunities to clearly define my risk and manage downside potential and make sure you have stops and things all updated for the charts that are starting to roll over. Now, the daily chart of the S&P, my last couple guests, we talked with John Gagliardi about this chart. I asked Craig Johnson on Wednesday to take a look at this chart and give me their take. If you listen to both of those interviews, and if you missed either of them, it's no problem. Go to StockChartsTV.com and you can check that out on demand. But both of them sort of agreed with the general assessment that I've been describing, which is this recent move we've seen, you have to label it as a bear market rally. The longer-term trend, we rotated from a pattern of higher highs and higher lows to now a period of lower lows and lower highs. Until that changes, I'm inclined to keep labeling any sort of rally move as a bear market rally, which essentially means it's a time to reinitiate shorts. It's a time to do short-term swing trading, but it's really not a longer-term pattern. The chart will tell you when it's more of an accumulation phase, and that's when you start to put in higher lows. That's when you see breadth conditions turn up. That's when you see a momentum indicator start to rotate higher. I don't think we're necessarily seeing that yet. By the way, I just put a new video on my YouTube channel yesterday dealing with bullish and bearish momentum divergences. So go to my Market Misbehavior YouTube channel if you didn't see that one, because we'll address this particular pattern in the S&P and how that relates to the comments we just made about a bear market rally phase. Looking at some measures of breadth, these overall I think remain fairly negative. Some of them have not really capitulated to the downside yet. And I think what will be interesting today, given the weakness that we saw in the S&P, if you see this breadth line, the cumulative advanced decline line, finally break below the lows from early December of last year. The rest of these all have already done that. The S&P breadth is the only one that is still sort of holding on to that I guess not quite bearish signal. That's why I have it colored sort of a neutral amber color. Depending on what happens after the close today, once we digest all the closing data and update these breadth indicators, I wouldn't be surprised if this is pretty close to breaking down, at which point I'll probably color code all 4 of these red if and when that happens. The trend is certainly pointing lower in terms of measures of breadth. When you look at the percent of stocks above moving averages, both of these are in bearish territory as well. In general, I like to see over half of the S&P above their 200-day moving average. That tells you the long-term trends are positive. That's not the case. It actually went below the zero line in late January, and overall has spent most of the year below there as well. Percent of stocks above their 50-day moving average, currently around 35%, which tells you, again, 65% of the S&P members are below their 50-day moving average. That remains below 50%. That's not a real sustainable bull market phase yet. It gets back above 50%, you will hear me start to have a much more rosier outlook and more constructive way of describing the market activity. Breadth measures being negative tells me that this is still a cautionary environment. You're certainly seeing new lows dry up a bit. Now, part of that is because you had a big acceleration down on the news from Ukraine last week as we all sort of digested that initial sell-off, and it bounced quickly to the downside. You see a lot of stocks made new 52-week lows there. Many of them have bounced off there. Charts like Netflix and others kind of come to mind. The kicker is they're really close to making a new swing low, sort of finishing the week fairly weak. And we'll see if that continues next week. I think you'll see an expansion in new lows in a way that we haven't yet. Finally, the bullish percent index remains below 50%. So you can see all of these breadth indicators, for the most part, fairly negative. I'm not seeing a lot of constructive signs just yet, and I think those are important charts to watch now. When the market's going lower, step 1 is confirm that trend, which I think we have. Step 2 is look for a series of charts that will help you understand when that downtrend is over. We're not seeing that yet, but these breadth charts would need to turn higher. Crossing the 50% line, the zero line on some of those could be an important indication of a recovery phase. We need to take a quick break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we break down the market activity using the power of stock charts. A couple quick announcements before we open the Final Bar mailbag. First off, the questions in that mailbag come from all of you, sending in questions about technical analysis, particularly technical indicators, stocks and ETFs that you're trying to make sense of, whatever it is. We're here to help you on your investing journey. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'll gather all those questions and hope to answer one of yours live on the air Tuesday of next week. Also, go to StockChartsTV.com. That's our on-demand platform. Great guest appearances like John Gagliardi, Craig Johnson, Dale Pinkett from this week. Special events like The Pitch, Larry Williams' market outlook that he shared last week, so much more, all for free at StockChartsTV.com, or on your mobile device, just search for Stock Charts TV on demand. Let's open the Final Bar mailbag. As a reminder, our email is thefinalbar@StockCharts.com, and let's answer question number 1. I read in a lot of market analysis articles about the support and resistance levels of an index with the help of calls and puts. How much accuracy can this method offer? Can you suggest any books for further reading? Yeah, so when we talk about sentiment, we often include a couple put-call charts, and of course, it's probably a bad time to ask me, because if I remember right on the show yesterday, I was like, well, put-call ratio is not telling you a ton right now, and I feel like some of the other sentiment indicators are a little more compelling at the moment, and I think that's the case. The idea with put-call ratios, there are a couple different things you can do. You can look at put-call ratios, you can look at put-call volume, you can look at a number of different ways of smoothing out put-call data over time, as with other methodologies. The most common way that I look at it is a total and equity-only put-call ratio, just a ratio of the two sides of that, put options versus call options. And I plot it this way, and essentially a high put-call ratio usually coincides with market bottoms. A low put-call ratio usually coincides with market tops. So it's a lot like the VIX in terms of its inverse relationship in general to stock prices, although that's not a perfect, inverse relationship. There are plenty of times when it will surprise you, same as you would see with the VIX. But it certainly has been noteworthy, particularly spikes in the put-call ratio. If you look back over 2020 and 2021, through sort of the middle of this chart, you can see the put-call ratio being in the upper end of that range, usually coincided with some of the most buyable dips that you saw through the course of that period. The challenge is it's not upward bounded, similar to the VIX. So the put-call ratio can accelerate to the upside. How do you learn more about that? Two things I would point you to. In our chart school section, just search for put-call ratio, and you'll get some articles and also some blog posts where some of our commentators talk about the put-call ratio, and that can probably help you. Particularly the notes from commentators can help you understand how they're applying it in a real-life market situation. In terms of a book, Larry McMillan is McMillan. Wow, not McMillian. Larry McMillan, who we've interviewed for StockCharts TV before. He wrote a book called McMillan on Options, which is a dense read on all things equity derivatives. It's worth picking up if you're dipping your toe into that market, but it includes some put-call ratios and other option-related indicators that could be of help to you. Next question. If you only had one piece of advice for someone joining the stock market after the highs and is now trending downwards, what would it be? Hang on would be my first piece of advice, I guess. It's a good question, and I think what you're suggesting is if you just sort of, are just getting into the market now, right, at the end of last year, beginning of this year, and now we're starting to roll over, what would you suggest? So here's the kicker, and I've talked with a number of my guests about that. I don't know how much of that we've done on the air. A lot of times I'll chat with guests before the show or after the show and chat about different things, but we've often talked about how some of the newer investors, if you're just getting started investing, you really haven't experienced a bear market phase, and if you haven't experienced that many of them. And I remember I learned technical analysis in 2000, 2001, 2002. That's when I was really studying. That's when I was starting to prepare for CMT exams, and it was a secular bear market, and it was a cyclical bear market within the secular bear. So technical analysis for me was all about risk management. It was all about, recognizing downtrends. And the people that survived that era were the ones, as an investor, were the ones that got defensive and the ones that recognized the negative signs. For me, that's always sort of given me a bit of a bearish bias to my analysis, which I've actively tried to compensate for as much as possible. But I would say is remember that in an environment like this, there are usually things that are working. So that's number one, is make sure that you look for opportunities. So in energy and materials, even in industrials, in utilities, in REITs, there are plenty of stocks that are actually breaking out and doing just fine right now. So make sure you're looking for stocks making new highs during this sort of period. The other one is make sure you have your stops updated. A lot of times, you don't want to wait for a position to really be hurting you before you develop an exit strategy. I always share with people the analogy of flying an airplane, right? You develop your exit strategy, you develop your emergency plan when you're flying straight and level and you're having no problems. That's when you're looking for an airport. That's when you're trying to find where you would go and how you would land the plane in the case of an emergency. You don't wait for the engine to cut out to figure out what you're going to do next. I would do the same thing with your portfolio. Look now, if you're sitting on paper gains, if you have positions that have been working, update your stops now and make sure that you cut or get out of those positions when they stop working for you. Next question. Questions about stocks making new highs and new lows. Are exchanges or indexes best to watch for bullish or bearish market trends? When tracking the trends, is it best to use a count, a ratio, or a percentage of the new highs to new lows? That's another really good question. I don't really talk about new highs and new lows too often on the show and in my own process, to be honest with you, only because I have a lot of things that I look at, and I found early on in my career, you have to limit what you're looking at. You can't look at everything, and if you do, you will open yourself up to what's called confirmation bias. You will just find reasons to do what you already wanted to do. I want my process to be relatively straightforward, relatively simple, and I want it to be evidence-based. Having said that, with new highs and new lows, there are a number of things you can do. I tend to keep it pretty straightforward. I look at the number of new highs and I look at the number of new lows because I'm always interested to see how many stocks are making new highs or new lows right now versus what's been happening recently. And you can tell when there have been an incredible number of new highs and absolutely zero new lows, and when that starts to change like we saw in late November, December of last year, I find that jumps right off of the chart. I have no problem recognizing that shift. in the overall environment. Having said that, people look at ratios of new highs over new lows. You can look at smoothing that out and looking at cumulative measures of new highs and new lows. All of those are totally fair. And again, I'd point you to the Chart School articles we have. Just search for a keyword like new high or new low, and you'll get some articles. And particularly, I'd point you to when you can search for blog posts that use those keywords. That can be really helpful because it will help you find where some of my fellow expert commentators, when they're actually applying those indicators in a real life market situation, I think that can be most helpful. Last question. How do you view stocks that have already run up and have become overbought like NTR? I'll bring that chart up as I'm finishing. You've got a pretty wordy question here, but we'll get through it. I suspect the market is going to roll around for the next 6 months, but toward the end of the year, after all the digestion is done, I suspect the market will be leading out of its bearish cycle. Do you believe stocks in the XLB, the materials sector, should be considered as a hold or even buy for the next 12 months? So I have to start by saying a full disclaimer. I can't recommend anything. I'd encourage you to make your own decisions, consult a financial professional for your own decision-making purposes. But what observations can I make? So number one, I would say in your question is embedded a little too much confidence, I would argue, arguably overconfidence in terms of the projected path of the market. I have no problem thinking through a potential future path and thinking, listen, cycles probably say we're going to peak out, if not already very soon. We roll over through, the fall, and then we rally into the end of the year. I have no problem with thinking through that scenario and what that might do to your portfolio. I would not get too married to that scenario mentally, that you're not prepared for when something totally different happens, because at this point it is a pure guess that you are doing. So I would just caution you with that. Make sure that you're open to what the markets are telling you. Having said that, materials I think have been pretty strong. A chart like NTR demonstrates the strength in that sector. Charts like Alcoa, charts like Mosaic, all in the materials sector. Even the gold stocks starting to do well. Other mining names like BHP and Rio and others. There's so many stocks in that sector doing well. Agriculture has been a long-term strong performer, but other parts of the sector are emerging well as well. This sort of plays into the whole infrastructure spending, recovery of the economy coming out of the coronavirus, sort of era, all plays well to the materials trade. So I like the thesis overall. I think that plays well to materials, to industrials, and to other things as well. The caution, or the thing I would concern yourself with a chart like NTL, is just the tactical side of it, right? Buying into something going straight up can be difficult to do. And I know working with institutional money managers, we would always look for this sort of pattern. Look at how NTR was rallying, accelerating to the upside December of 20, January of 21. Those overbought conditions led to a brief pullback, and those were much better times to get in. I might be looking for something similar right here on NTR. That's our final bar mailbag. Thanks for all those questions. We need to wrap the show. Go to the 3 in 3, 3 charts in 3 minutes. Let's get to it. Chart number one is the consumer discretionary sector, the XLY. Certainly a number of the key names in this sector have been struggling. The three biggest stocks, which make up almost 50% of the XLY, are Amazon, Home Depot, Tesla. All three of those have been on the struggle bus of sorts recently. From a technical perspective, you can track a clear pattern of lower highs from January to February to now early March. What's even more concerning to me is the fact that the relative strength is making a new multi-year low today. On Friday's close, you're seeing the relative strength break down, which is not an encouraging sign for consumer discretionary, which again, a traditional form of offense. Chart number two is taking that a step further. Let's look at consumer discretionary versus consumer staples, the XLY versus the XLP, and then the equal weighted version of these charts in the bottom panel, the RCD and the RHS. We have reviewed this chart many times on the show. I hope you've been recognizing this rotation from risk on to risk off, and that's what the last 3 months have been telling you. Since November, this has been in a risk off configuration with defense outperforming offense. That tells you that the bottom is not in yet, according to that measurement. Chart of Netflix is our third one. I looked at Netflix and Meta platforms, just thinking of one of those two. I was looking at the FANG stocks earlier. Netflix didn't quite make a new closing low for the year, but it's really, really close. We're within a rounding error of the close that we had in January. So what's happened with Facebook and Netflix, they gapped down, they bounced. And on that bounce, that's when I had a lot of people saying, all right, that was it. We puked out. That's the bottom. That's it. We're now going to rally from there. Notice how both of those are now retesting the lower end of the range, close to making a new low for the year. Folks, that is our show and a wrap for this week on the Final Bar. Thanks for joining us every weekday after the close. Check out all of our previous shows on demand. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.